Welcome, sir. The time is yours.
Thank you. Thank you for introducing me. Am I audible?
Yes, sir. Very
Yes,
much.
sir.
Okay. Let me just check my sound. 1 second. I'll make it 100%. Okay. Right. So, good morning to all of you, all the participants. I understand there are people from different places. So, our topic today is, in fact, being the first day, I am a little apprehensive because the topic should have actually come a little later, because after understanding investment and so on, because this is after understanding investment, how do you manage the risk? It doesn't matter, but still we can understand, no problem. So I have a presentation. I will make the presentation and the copy will be shared with you also, so that it can be shared with the participants. If you have questions, I think we will have a break in between, then you can ask questions, and towards the end also you can ask questions. So that is my plan. So I'll go to the presentation. Right. Yes. Is this slide visible?
Yes, sir.
Okay, right. So financial derivatives for risk management in investment. I shall repeat once again. Financial derivatives for risk management in investment. So actually, there are three words, terms used in the title. So three important words have been used in the title. Let us list out those three words. So one is investment. Second is risk. And third is derivatives. So what we are trying to understand these three terms. And these three terms are interrelated. We have to understand what is investment, then we have to understand what is the risk in investment, and then what is the role of derivatives in managing the risk in investment. I'll go one by one. We'll take the first word, investment. Let us try to understand the meaning of investment. For that, the best thing to do is to think of an investment, a real investment which all of us make, an investment which we are familiar with. From there, we will go to the meaning of investment. That is the best way to handle this. So all of us I think all of you are teachers, so you have money. So you are, I'm sure you definitely make investments. Maybe some of you might be investing your money in the fixed deposit, bank fixed deposit. Some of you may be investing your money in the post office fixed deposits. Others may be investing in cooperative banks or cooperative societies, or sometimes private banks like Muthoot Finance and so on. So they are private NBFC, we call them NBFC, non-banking finance companies. They're not strictly banks, but they do some financial services, non-banking financial institutions, NBFCs. So, and some of you might be investing in the share market, purchasing shares, because now people are familiar with the share market, and at least their friends may help them, or somebody else may help them, or they may seek professional help and purchase some shares to create wealth. In fact, investment is, we are trying to increase our money. You get salary. If you keep the salary in your house, it remains there as it is. In fact, the value of the money will go down because of inflation. the value of your money which you keep in your house as liquid cash will go down. So what we are trying to do is we are trying to increase the value of our money, the value of the money that we have, the savings that we have, or more precisely, we are trying to create wealth. So investment is actually wealth creation for future use. We will have many requirements for money. So whatever salary we have, we save some money and then we try to increase the value of the money. In that process, we are creating what is called wealth. So let us take, so these examples which I gave you, some of them are very simple, some of them are a little complex. So let me give you two examples. One is very simple, the other is very complex. The simple example is the bank fixed deposit. The complex example is shares. Bank fixed deposit, all of us know. We go to a bank, fill up a form, you give the money to the bank with the form, they will give you a receipt, a fixed deposit receipt. We are putting the money for 3 years, 5 years, 7 years, because there is an interest rate. The bank is offering an interest rate, and therefore that interest will be added to the fixed deposit. So you are increasing the value of your money. On the other hand, you can, if you want, you can buy a share from the share market. Very easy to buy a share. You can sitting at home. You don't bank. You have to go to the bank to make a fixed deposit. Online also you can do, but still, shares you can buy from your house. Online platforms are there, so you can buy a share of a good company, hoping that the share price will go up and you can sell it later at a higher price. So these are the two examples. From these two examples, let us understand the meaning of investment. It's a commitment of funds. See, we have some money with us, savings with us. We are committing that money to somebody outside, either to a bank or a cooperative society or a mutual or a non-banking finance company, or we are investing it in committing the funds for purchasing a share. So it is a commitment of funds. We are from our hands, the money is going. Money goes out of our hands to an organization or to the share market. And we are committing the funds not to take it back tomorrow. We are not going to take it back tomorrow. We are planning to take it back only after 3 or 4 or 5 or 7 years. So it is for a future period of 3, 5, 7 years. So we are prepared to commit our funds for a future period with somebody, with some institution, because we are expecting a return. We are expecting a return. We are expecting an interest rate, or we are expecting an increase in the value of the share. So for an expected return, that is our expectation. That is their offer. We are expecting it. We hope that we will get that return. We hope that the share price will go up. So we are committing our funds for a future period for an expected return. But unfortunately, sometimes you will not get the return. If you put the money in a bank, no problem. But even then, nowadays we hear about some of the big banks being in trouble. SBI, for example. So we read some reports that SBI is in trouble. So if the bank fails, you may not get back the money. If you put the money in a cooperative society and if the cooperative society fails, you will not get back the money. If you if you put your money in a private bank, they may fail or they may refuse to give you back the money. You buy a share, hoping that the share price will go up. But next day, what you see is the share price is coming down. Next month, you see that the share price is coming down. You can't do anything about it. Your money is being lost. That is called risk. So there is an inherent risk in investment. In some cases, it may be very low. In some cases, it may be very high. So there is a possibility that you may not get the return that you are expecting. There is a possibility that you may sometimes even lose your investment. The share price may go down very much, and then you lose your money which you put there. So there is always the possibility that either you will get lesser return or you will lose your money, you will make a loss. So that possibility, it may not happen, but still the possibility is there. That possibility is called risk. So in investment, two things are important. One is the return that you are expecting. The other is the risk that is hidden in that investment. We like the risk, we like the return, we do not like the risk. So we want the return, but we don't want the risk. So how do you avoid the risk? How do you eliminate the risk? That is what we are going to see. Okay, before that, let us understand the second term, risk, a little more. What is this risk? Take the case of a share. Best way to understand risk is to look at a share. You purchase a share hoping that the share price will go up and you can sell it later at a higher price. But unfortunately, in most cases, what will happen? The share price will start going down. Sometimes it goes up, sometimes it comes down. You cannot predict what will happen to the share. It depends upon so many factors. So what is risk? It's the possibility of unfavorable variation in the return. It's a possibility. So unfavorable variation, you are expecting 10% return, you may get only 5% return. Unfavorable variation. Or the possibility of incurring a loss in investment. You have purchased a share for 350 rupees. The share price is now 200. You already lost 150 rupees. So the possibility of incurring a loss in investment. So both these things are possible. That possibility is what is known as risk, and it is inherent, hidden in the investment. In some cases, it may be very low. In some cases, it may be very high, and it has to be managed. The risk has to be managed because we don't like risk. We like return. We don't like risk. So it has to be managed by minimizing or avoiding it. Either we have to minimize it or completely avoid it. If possible, avoid it. Very good. At least minimize it. And that process is technically called hedging. This process of minimizing or avoiding, eliminating the risk in investment is called hedging. So there is investment. In the investment, risk is hidden, and we want to eliminate or minimize the risk through the process called hedging. Okay. Now we come to the third term in the title, derivatives. So these are some instruments which we are going to use for hedging the risk in investment. For hedging the risk in investment. These are hedging instruments. So we call them as hedging instruments. You know now what is hedging. Hedging means minimizing or eliminating the risk in investment. And that the instruments used for that are derivatives. So the simplest definition of derivatives are they are hedging instruments or risk management instruments. There are two types of derivatives. One is called commodity derivatives. The other is called financial derivatives. Commodity derivatives are used for hedging the risk in commodity trading, say gold, rubber, oil. So whenever you trade, there can be risk. That risk is covered by commodity derivatives. We are not going to study that today. The second category of derivatives is called financial derivatives, and these are used for hedging the risk in investment. Whenever you invest your money somewhere, especially in the share market, there will be risk, high risk, and the risk can be minimized or eliminated through financial derivatives. So this is our topic. Financial derivatives for risk management in investment. You have understood what is investment, you have understood what is risk, and we have seen what are derivatives. We are going to see more about derivatives. Okay, introductory remarks. Let me start with some introductory remarks about derivatives. These derivatives are financial innovations. They are new. They have been introduced recently, of recent origin. So derivatives are financial innovations of recent origin. They were not there in the 19th century or 18th century, even the beginning of the 20th century. Derivatives trading is an important economic activity globally, even all over the world. Now, derivatives trading is an important economic activity. It became popular only during the second half of the 20th century. Second half of the 20th century. That is 1950s, 60s, 70s, etc. In India, it became popular only towards the end of the 20th century. So that is why I said these are innovations, financial innovations of recent origin. Even now, many people do not know what these are. That is why I have written a book and I'm taking classes on derivatives, because it's very unfamiliar, but very useful. And this is set to dominate the commodity and financial markets soon. So the commodity and financial markets is going to be dominated by derivatives. So what we are trying to understand is the basic concepts of derivatives and the practice of derivatives trading. How do you buy and sell these derivatives for risk management? That is what we are trying to understand. Basically, it's a topic which is taught in a semester. It takes about one full semester to learn the whole thing. So you can understand with 2 hours, what can I do? I can only introduce to you the basic concepts. At least you get an idea about what these derivatives are and how useful they are in risk management in investment, because your topic of the webinar of this FTP is investment. Right, now let us start with a few interesting situations, typical situations which require the intervention of derivatives. For example, let's take an investor. All of you are investors in some way or the other. Supposing you have invested money in shares. So you have purchased some shares, some good shares, hoping that the share price will go up. Now you find that you are anticipating a decline in the prices of shares held by him. So there is an investor, he has shares, he wants to make some profit out of it because he hoped that the share price would go up. But now what he is anticipating from the research studies published in the newspapers and so on, he is anticipating a decline in the prices of the shares held by him. What will you do? What to do? See, it's a very serious situation. Practically, those who have shares and are facing this situation, they will be in trouble. They'll be very sad because they don't know what to do. So those who do not have shares, it's only theory for them. But those who actually have shares and find that the prices of the shares are falling or is going to fall, they will be in real trouble. So, in other words, there is a possibility of incurring a loss. So he's anticipating a decline in the prices. So that means there is a possibility of incurring a loss. He has to eliminate this loss. That is what we are going to study. So he has to eliminate this loss. What can he do? What to do? He can use derivatives. He can use derivatives. For that, so we have to study what are derivatives, how to use them. And once you understand that, then you can be very confident. He can make his investment very confidently because derivatives are there to help him to manage the risk. So here there is a possibility of incurring a loss. There is a risk. You want to eliminate the risk or you want to hedge the risk. And what to do? Use derivatives. Okay. Mutual fund. Commerce teachers would have heard about, they know about mutual funds. Even others would know. A mutual fund is an organization which collects money from people and pools the money and invests this money in the share market to buy good shares. And when the price of the shares go up, they distribute the profit among the mutual fund holders, those who purchase the mutual fund units. So the profit will be distributed among them. So if I have some money, I can put it in a mutual fund. Instead of putting the money in a bank, I can put the money in a mutual fund. So that the mutual fund will do everything for me. They will purchase shares. So they are investing. The mutual fund is investing. They will purchase the shares. They will do the analysis. And when the share prices go up, they will get profit. And that profit will be distributed among us. So a mutual fund is, I am investing in the mutual fund. And mutual fund is doing investment for me. And what they do is they will announce, they will announce a scheme. Okay, we are starting a new scheme. So those who want to join, they can join. And so 1 month's time will be given for people to join the scheme. So many people will join. So they will collect crores of rupees in a period of 1 month. So announces a new scheme and expects to receive the money after 1 month. 1 month. And what are they going to do? They are going to the share market and purchase shares, just like the investor before. So they are also going to the share market and purchase shares, hoping that the share prices will go up. But there is a 1 month's time is there because they will get the money only within a period of 1 month. So 1 month's time is there to collect the money. Meanwhile, the mutual fund is anticipating an increase in the prices of shares. So the mutual fund, when they did the analysis, they are anticipating that the share price will increase, which means when the money is ready, they will go to the share market to buy, but the share price have increased. Earlier, if they had the money 1 month earlier, they could have purchased the shares at a lower price. Now, when the money is ready, they are anticipating that the share price will go up, so that they will buy. They will have to buy the shares at a higher price, which is, again, there is a possibility of incurring a loss because they have to pay higher prices. So there is a risk here. There is a risk here. The mutual fund is facing a risk in their investment. There is a possibility of having to pay more prices for the shares. So the possibility of incurring a loss is there. What to do? So how to overcome that risk? How to hedge the risk? Again, you can use derivatives. See that. So derivatives are hedging instruments. So in situations where you have a risk, you can use in your investment. When you have a risk in your investment, you can use derivatives. So that for that you have to understand what are derivatives, how are they used. That is what we are going to, what I'm going to present and what you're going to try to understand. Now let us take another situation, another interesting situation. An exporter. He has exported something from India to USA, let us say, software or marine products or cashew products. So he has exported goods to USA, and he's expecting, he's expecting to receive the export sale proceeds in US dollars after 1 month, because there is some procedures are there. So goods have been sent already from here. The goods will reach there by another maybe another 15 days. It may be sent by ship, and so it will reach there. Then there's some processings are there. They will have to verify it. They have to see health checking is there. So after all that, after about 1 month, the exporter is expecting to receive the export sale proceeds in US dollars. The Americans will not give us rupees. They will only give us dollars. They don't have rupees with them. So the international currency, rupee is not an international currency. So international trade takes place in international currencies like euro or US dollars or pound sterling and so on. So this exporter is going to receive US dollars after 1 month. Very good. Excellent. But the problem is this money, this US dollars have to be converted into Indian rupees. In India, you cannot use dollars. In some countries, you can use dollars. If Gulf countries, for example, you can use US dollars. They accept. In the shops, they accept US dollars. But in India, we cannot use US dollars for transactions. So this exporter has to convert the US dollars into Indian rupees when he receives it. There's a problem there. He is anticipating a decline in the dollar prices. So let us say that today dollar is 75 rupees. $1 is 75 rupees today. But he has not received the dollars. He's going to receive the dollars after only 1 month. So by the time he receives the dollars, he is anticipating that the dollar price will go down to 70. Now it is 75. If you got it now, you could have converted it at 75 rupees per US dollar. But he is anticipating a decline in the dollar prices. It may go down to 72, 73, 70. It's because the dollar exchange rates are fluctuating constantly. So he is going to suffer a loss. If the dollar goes down to 73, he is going to suffer 2 rupees per US dollar from the current situation. So there's a possibility of incurring a loss when he is trying to convert the US dollars into Indian rupees. He is facing a risk, the possibility of a loss. So what to do? You want to eliminate that risk. You want to avoid that risk. That is a foreign exchange risk in foreign transactions, international transactions. So this is very common. This exporters and importers, they face a very huge risk here when in their transactions, because they have to convert the currency into Indian rupees, and the currency rates are always fluctuating. So they are always facing risk. What to do? They can also use derivatives. So derivatives can be used not only in investment. We are studying about investment, but it can be, I just wanted to mention to you, show to you. So derivatives are instruments which can be used for managing the risk in any situation, not only in investment. Here, this is an transaction, trading transaction, international transaction. So there is a risk here. There also derivatives can be used for managing the risk. Okay, so we have got an idea about the situations which require the use of derivatives. Okay, now it is time to understand what are derivatives, what are those instruments. We said derivatives instruments. Derivatives are financial instruments, hedging instruments. So what are those instruments? I use the plural, instruments. So that means there are more derivatives. We are using the word derivatives, not singular, plural. So that means there are more than one type of derivatives and so on. Okay, we'll see all those things. Okay, I hope you are with me. Okay, somebody? One of you?
Yes,
Are
I
you?
did.
Yes, sir.
Okay.
Yes, sir.
Okay, right. Uh, so the solution to these situations which we have seen an investor who is facing a risk. We have seen a mutual fund facing a risk. We have seen an exporter facing a risk. So all these people are facing risk. What is the solution? What to do? They were asking the question, what to do? The derivatives provide the solutions in all these cases because they are hedging instruments, risk management instruments. So question is, what are derivatives? What are derivatives? These are instruments traded in the financial markets. So first of all, there are some instruments. They are traded in the financial markets, just like shares, foreign currency. So just like those assets, these are also traded in the financial market. And these derivatives are linked to some other asset, financial security or asset like equity. Equity means share, commodity, currency. So always derivatives do not stand separately. They don't stand on their own. They are always linked to some other asset. So the other asset is the important one. The share is very important. The commodity is important. The currency is important. See, the exporter is going to get foreign currency. The mutual fund is going to buy shares. The investor has already purchased shares. He's holding the shares. So that those assets are important. The equity or the shares is important. Commodity is important. Currencies are important. These derivatives are helping them to manage the risk, to eliminate the risk. So they are only helpers. Derivatives are helpers. The real assets are the shares and the currencies. These are always linked to some other asset. These are trying to help those assets to manage the risk. The risk is in shares, the risk is in currency, the risk is in commodity. So we want to eliminate the risk. So a derivative is used and linked with that. So derivatives linked with these things, these assets to eliminate the risk involved there. And therefore, the instruments used for hedging the risk in the linked asset. So these are derivatives are actually instruments used for hedging the risk in the linked asset. The underlying, that is called underlying asset. The linked asset is called the underlying asset. So if a derivative is linked to equity, equity is the underlying asset. We are trying to hedge the risk in equity. If a derivative is linked to a currency, US dollars, then we are trying to hedge the risk in the US dollars. The underlying asset is the US dollars. So the underlying asset is the important one. These derivatives are just to help them. So they are not independent, they are dependent on the equity. These two are linked together. Okay, so that is the nature of derivatives. It's a helping instrument. Right. We have seen already what is risk and hedging. I think that's okay. What are the assets that need hedging? What are the assets that need hedging? The assets that need hedging are the assets whose prices are fluctuating. See, supposing I want to buy a mobile. There is no risk involved in buying a mobile because the price is the same. Today the price is the same. Tomorrow the price is the same. Today evening the price is the same. After 1 week the price will be the same. Maybe they will change the price after 6 months. So once in a while they may increase their price when their cost of production increases. But on a day-to-day basis, the price of the mobile is fixed. The price of a book is fixed. You want to buy a book. There is no risk in buying the book. You can buy it today, you can buy it tomorrow, you can buy it anytime because the price is the same. So there is no risk involved there. There is no possibility of incurring a loss because the price is fixed. Whereas if you try to buy a share or you try to sell a currency like US dollars, You are trying to sell a currency like US dollars. So you try to sell it today, you try to sell it tomorrow. Each day the price is different. So you have to be very careful. So the price is changing. You want to buy a share, the price is changing. So today it may be very high, tomorrow it may be very low. So when to buy? So there is a risk there. The risk, a possibility of incurring it. So the assets that need hedging are the assets whose prices are fluctuating. In the case of assets which are not fluctuating, you don't require hedging. You don't require derivatives. Gold prices, commodity, take commodity, gold prices are changing. Every day it is changing. So you need derivatives there because there is a possibility of incurring a loss. So assets that need hedging are one, equities, shares. The prices of shares are always changing. Currencies, the price of currencies are changing. Foreign currencies are changing. Commodities like gold, rubber, oil, prices are changing. So that is why commodity derivatives. Commodity derivatives are used in the case of commodities whose prices are fluctuating. Currency derivatives will be used for hedging the risk in currencies. Equity or share derivatives will be used for hedging the risk in equity. Loans. If you take loan also, the interest rate is the price of the loan. The interest rate is the price of the loan. The interest rate keeps on changing every 2 or 3 months. So Bank of India will change the interest rate. So there also you will require hedging. So derivative instruments have been created recently, about 50 years back. So these derivative instruments, they are very new. They have been created for hedging the risk in these assets. So they have been created very recently. About 50 years is not a long period. So during the last 50 years, derivatives have been created through financial engineering to hedge the risk in these assets whose prices are fluctuating. So we need derivatives for hedging the risk in investment, in foreign currencies, in commodities trading, etc. So even though we are concentrating on investment, it is useful in commodities trading, in currency transactions, everywhere it is useful. What are derivative instruments? Okay, what are these derivative instruments? We said derivative instruments which are traded in the market and so on. So 4 basic types of derivative instruments. There are 4 derivative instruments. Any of them can be used. They are forwards, futures, options, and swaps. Swaps are not very important, so we can leave that out. The 3 important ones are forwards, futures, options. I am planning to give an idea about these 3 and how they are used in hedging the risk. That is my purpose. What I have planned is to introduce what is a forward, what is a future, what is an option, then take some examples and show how they can be used for hedging the risk in investment. We are not going into currency trading. Currency trading I will show, but commodity I am not going into commodities. Okay, so we are going to start with the forwards, which is one of the derivatives, which can be used for hedging the risk. So what are forwards? How are they used to hedge the risk? This is what we are going to see. Forwards. Okay. Now, again, see, as I said, derivatives are new, therefore it is unfamiliar, therefore people think that it is very, very difficult. In fact, it is not. These instruments are not at all difficult. They are very simple instruments. Only because we are unfamiliar, we think that they are difficult. Say forwards. These forward contracts are part of everyday life. So there is nothing new there. Only we did not call them derivatives. Only during the last 50 years, we started calling them as a new kind of instrument called derivatives and so on. But these forwards were part of these, they are forward contracts. They are contracts called forward contracts. They are part of everyday life. We are very familiar with them. I'll give you 2 examples. Luxury car and a real estate. You want to buy a simple car like Maruti or some ordinary car, which costs about 5 or 6 or less than 10 lakhs. It's very easy. You go to a showroom, the car will be there. You pay the advance or EMI, pay the money, and you sign the purchase agreement, give the money, they will give you the car. So the transaction is over, just like buying a book. How do you buy a book? You go to a shop, you give the money, take the book, over, finished. How do you buy a mobile? Go to a shop, select the mobile, give the money, and they will hand over the mobile to you. That is the purchase sale transaction. So in an ordinary car, the purchase sale transaction is similar. The car will be there already, it will be exhibited there, different types, different colors. You can choose and you can pay the money and you can take it away. But in the case of a luxury car which costs about 1 crore rupees, I don't know the names. Anyway, we know that there are some luxury cars. So they are costing very, very high. Let us say a car is costing 1 crore rupees. So you go to a dealer, the car will not be there ready-made. Such costly cars will not be there ready. So you will have to inquire about it. What you have to do is you have to book a car. Okay, you say I want this luxury car of this color, this type, and so on. Give the specification. The company, the dealer will say, okay, I'll get in touch with the company manufacturer. So they will say, okay, within 1 month or 2 months, I will get you the car. So you give me an advance. So the buyer gives an advance. They sign an agreement. The dealer and the buyer signs an agreement. The dealer agrees to buy the car at a price. The price is fixed. Okay, now the price is fixed. Time of delivery is fixed within 2 months. So there is an agreement fixing the time of delivery, fixing the price and other details. So both of them sign the agreement for future delivery of the car. Okay, and pay an advance. After 2 months, the car will be ready. It will be coming from the manufacturer and you can pay the balance money and you can take away the car. Okay, this is a forward contract. We did not call it a forward contract earlier. Now we know that it is called a forward contract. Similarly, real estate, all of you know how to buy, most of you would have purchased land. So we don't purchase land just like buying a mobile or a book. You don't go to the registrar's office one fine day and sign the agreements there. No, we select the property. First, you enter into an agreement with the other party, specifying the price per cent and also the time within 3 months. So there's an agreement which says that within 3 months the sale deed will be executed in the registrar's office. So we are fixing a price per cent, everything is fixed. So there's an agreement. That agreement is signed by both the parties. That is valid. It's on, on a 100 rupee stamp paper. It is valid agreement. Then as per the agreement, the price is fixed already. So you give an advance, just like in the case of the luxury car. Then after the 2 or 3 months period, you go to the registrar's office and then there you sign the sale deed in front of the registrar. So there are 2 stages, 2 steps. One is an agreement to do a trade in the future. An agreement to purchase or sell something in the future. Second is the actual purchasing and selling transaction which happens in the future. So at present there is an agreement. That agreement is called forward contract. See, that is why I said forward contracts are part of everyday life. So we are familiar with that. There's nothing new to learn here. This is all familiar to us and therefore let us define a forward contract. It's an agreement to buy or sell. One person agrees to buy, the other person agrees to sell an asset. The asset may be a car, it may be a real estate, it may be a commodity like gold, it may be a share, it may be a foreign currency, it can be anything. Any asset, a commodity, financial asset like US dollars or a share at a predetermined price. So you're agreeing to buy in the future. You are making an agreement to buy or sell an asset in the future, but the price is fixed at a predetermined price. Within a specified future date, the future date is also fixed. Within that time, within that specified future date, you have to execute the real buying and selling agreement. So this is a forward contract. This is the derivative. This is the first derivative instrument called forwards. Very simple, a simple agreement to do a trade in the future. But the important points are the price is fixed, the time is fixed. Okay, now how is it useful? Where is it useful? And how does it reduce the risk? That is our purpose, isn't it? The derivatives are hedging instruments. They are used for hedging the risk in investment or in trading or in foreign currency transactions, etc. So how does a forward contract help in managing the risk? Let us see that. These are contracts for forward delivery, forward sale, not ready spot delivery. Now, we are not going to buy or sell immediately. We are agreeing, you are making a contract for forward delivery, forward transaction. It's a forward delivery transactions agreement. Okay, the currency forward is a typical example of how a forward is used for hedging the risk. Currency is the underlying asset, the linked asset. Forward is the derivative. Understand that? Forward is the derivative instrument. It is linked to an asset. Here we are linking it to currency. So we are going to use it for hedging the risk in currency. A forward contract is going to be used to hedge the risk in a currency transaction. Okay. Exchange rate fluctuations. So exchange rates, if exchange rates were constant and fixed, just like the price of a mobile, if the exchange rate of US dollar and Indian rupee is fixed at 75 rupees and it does not change, then you don't require a derivative. Then you will not require a derivative because an exporter can sell his US dollars at any time at 75 rupees. I hope you are following me. See, the problem arises because the exchange rates are fluctuating. There is no problem in the case of a mobile because the mobile price is fixed. If the exchange rates were fixed, US dollar, Indian rupee exchange rate is 75 rupees. It is fixed for the next 6 months. Then there is no need of any derivative. There is no risk involved there. The exporter can always sell, anytime he can sell his the dollar which he gets from America, he can sell it at 75. He does not face any risk. The risk arises because of the exchange rate fluctuations. The exchange rate is changing, so he does not know what will be the exchange rate tomorrow or next month when he actually receives the US dollars. So these exchange rate fluctuations expose exporters and importers to considerable risk. And they want to eliminate that. And forwards are used for hedging, eliminating the risk in foreign currency dealings. These are derivatives traded over the counter. They are known as OTC, over the counter products. So that is, the derivatives are traded, the agreements are signed. Forward contract is, all derivatives are agreements, contracts. So the forward contract is an agreement. It is signed over the counter. That is, you go to a bank. It is mostly traded in a bank. So you go to a bank, there is a counter there. On the one side of the counter, the bank manager sits. On the other side, you sit. The trader sits, exporter sits. So over the counter, they are signing it. Therefore, it is called OTC instruments, over the counter instruments. So, okay, let us take an example of an exporter, how he is going to use forward dealings in foreign currency. An exporter has exported goods worth US dollars 1 lakh to USA. Okay, so he has sent some softwares. He is expecting to receive US dollars. He has not received it. He is going to receive it only after 3 months. There are so many complications, so many procedures to be fulfilled. So he expects to receive the US dollars after 3 months. Current exchange rate, let us say, is 72.50. Okay, today it is 72.50. So if he received the dollars today, he could have converted it at 72.50. But tomorrow, what is the exchange rate? Nobody knows. Because there's nobody to fix it. It's not fixed. It is by demand and supply. So what is the exchange rate tomorrow? Nobody knows. What is the exchange rate 1 month later? Nobody knows. What is the exchange rate 3 months later? It may be higher, it may be lower. If it is higher, very good. He is happy. If it is 75, he is happy because he can convert it 75, but he cannot be sure. He cannot wait for that, hoping that it will be 75. That will be foolish. Totally foolish. So he is afraid that the US dollar may go down. Because if it goes up, okay, fine, let it go up. He's very happy. But he is looking at the other side. The US dollar exchange rate may go down to 70. That is what he is afraid of. Then he will be able to convert the US dollars only at 70 rupees. So he wants to avoid that. The going upside, he is happy. Increase in the US dollar exchange rate, is very happy. He's not bothered about that. He need not bother about that. He is bothered about the exchange rate coming down. He wants to do something about it. He wants to avoid that. So he wants to avoid the US dollar coming down to 70 or 69 or 65. He wants to avoid that by all means. He has to eliminate that. What to do? See, that is the problem. It's very simple. He will enter into an agreement. That's all. See, we have studied what is a forward contract. It's an agreement to buy or sell. So here he wants to sell US dollar. This exporter wants to sell US dollars after 3 months. That's all. See, this exporter, he wants to sell US dollars after 3 months. He does not know the price now. He does not know the price. What will be the price after 3 months? He is afraid. Therefore, very simple. He enters into an agreement to sell US dollars in the future, that is after 3 months, at around 72.50 or 72.25 or 72 rupees, at around this rate. So that is, he wants this rate. That's all. So he enters into an agreement. So finished. That's all. Then let the US dollar go up or down. He is not bothered because he has entered into an agreement. He will be able to sell it at 72, around 72.50. So his problem is solved. His risk is eliminated. So very simple agreement. A simple agreement signed across the counter with the bank manager will help him. He is anticipating a decline in the value of the US dollars. Therefore, he enters into a forward contract to sell US dollars after 3 months at, say, let us say 72 rupees. So that is negotiated between the bank and the exporter. That's negotiated between the bank and the exporter. It's called the forward rate. The current exchange rate is 72.50. 72, he is agreeing to sell US dollars at 72 in the future. Therefore, it is called the forward rate of the US dollar. That is negotiated. So his problem is solved. He will be able to sell it at 72, even if, supposing after 3 months, the dollar is only 65. The dollar is only 65, but he will be able to sell it at 72. Okay. Okay, so we don't have much time. So I think an importer, let's take the other side also, an importer. Importer has imported goods worth euro. Let us take another currency, euro, 1 lakh from Europe. So an importer has imported goods worth euro, 1 lakh from euro. The payment has to be made, not now. He has got 3 months time. He has to process those goods. He has to verify those goods, and then he agrees to make the payment. So the payment will be made only after 3 months. But he has to pay in euro. They will not accept Indian rupee. The European country will not accept Indian rupee. France, Germany, they will not accept Indian rupee. They want euro. So this importer has to convert Indian rupees into euro and send the euro to the European country. So he has to purchase. He has to purchase euro. The current exchange rate is 1 euro is 82 rupees. So today, if he wants to buy 1 euro, he has to pay 82 rupees. But he is not going to buy euro today. He wants the euro only after 3 months. After 3 months, what will be the euro rate? It may be 85. It may be 85. That means he has to pay more. If it is 85, if the euro price goes up to 85, he has to pay 3 rupees more than today's price. So he's going to suffer a loss. See that. If it is going down to 80, okay, good. He can buy at 80 rupees. He is happy about that. He is not worried about that. He is worried about the increase in the euro price from 82 to 83, 84, 85. He wants to avoid that. Very simple. See, he is anticipating an increase in the value. Increase in the value of the euro is anticipated. So very simple. You enter into an agreement. He wants to buy euro, so enter into an agreement to buy euro at around 82 or 82.20. So at around today's rate, you enter into an agreement to buy euro, not now, after 3 months. The price is fixed. So see, he enters into a forward contract to buy euro after 3 months at 82.50 per euro. Problem is solved, risk is eliminated. The forward contract has been used. One of the derivatives, forward is one of the derivatives. The forward contract has been used to hedge the risk in the foreign currency transaction. Okay. Operation of the derivatives. Okay, what we are doing is actually, see here, it facilitates the exchange of financial assets in the future at prices determined in the present. So we are exchanging selling or buying in the future, but the price is determined in the present. Or we say it enables the participants to lock in a price for the future transaction. This is what is happening, what I have marked in reading. Read that. It enables the participants to lock in a price for the future transaction because the prices are fluctuating. In these assets like foreign currency or shares, the prices are fluctuating. So we are locking in a price. And once you lock in a price, the price fluctuation is eliminated. So this is what the derivative is doing. So this derivative is a very simple concept. The derivative helps you to lock in a price for your future transaction. That's all. Very simple to understand. Once again, I repeat, derivative helps you to lock in a price for the future transaction where the prices are always fluctuating. So in a fluctuating market, you are locking in a price for a future transaction, thereby eliminating the risk arising out of the price fluctuation. So that's all simple. So one of the derivatives we have already seen now, forward contracts. And these derivatives are used only in the case of currencies. That is why I took the example of a currency, because it is not used in the case of shares or other commodities. Okay. Okay. Futures, can I go ahead or do you want a break?
Yes, sir, you may.
Okay, I'll go. Okay, right. So we are going to see, and now we have already understood. See, there's nothing complex here. Very simple. Derivatives are very simple. They are just agreements. Fixing a price. What we are doing is fixing a price, because the problem is the price fluctuation. We have seen one instrument. I said there are three instruments. The second is the futures. The third is the options. Now we are going to see futures. Now futures is the same thing. Same as forwards. It's an agreement to buy or sell an asset at a predetermined price and within a specified future date. The same. Agreement is the same. The only difference is that this is traded in organized exchanges, whereas forwards are traded across the counter of the bank. It is traded in a bank. So between the bank and the customer, OTC product, the agreements are made across the counter, whereas that is individual. Whereas futures are the same thing, same agreement, the same thing. What we are just now seeing, the same thing. But the agreement is made not across the counter in a bank, but the agreement is made through the exchanges, stock exchanges. In the stock exchanges, there is a separate section dealing with the derivatives. In our NSE, BSE, you're all familiar with NSE and BSE. They are the stock exchanges, two most important stock exchanges in the country. So in those stock exchanges, there is a separate division. There's a link there. You can click on that link and you can go to the derivatives section straight away. So there's a section for equity trading. There's a section for derivatives trading. So you click on the derivatives button there, a link on the home page, you go to the derivatives section. So there is a separate section in our stock exchanges. So these forward contracts, we enter into those agreements, buying and selling through the exchanges. I'll show you later on the exchanges where it is. The NSE and BSE, the same NSE and BSE. That is the only difference. There's only difference between a forward contract and futures contract. Okay, so there is nothing new to learn here. There's nothing new to learn. The same thing. But the trading methods is different. One is done over the counter. The other is through the exchange. And in fact, through the exchange is very easy because now it is online trading. Now all transactions are online trading. Sitting at home, you can do all the trading through online platforms. So futures, the trading of futures is much easier than the trading of forwards. Because for forwards, you have to go to an institution, meet the manager, then negotiate and so on. Whereas the other thing, futures is done through the online platform. So everything is done in seconds, the whole thing is over. Within seconds, you have to be careful. Don't make mistakes there. So once you click the mouse, the transaction is over. So here we have to be careful, but it is very quick. So that's all. The concept is the same. Okay, now let us look. Futures are most commonly used. I said forwards are used only for currencies, but futures are used very commonly. The futures are linked to different types of assets. We know that a derivative is linked to an asset to hedge the risk in that asset. Futures are linked to many types of assets. Therefore, we have different categories of futures. One, commodity futures. Commodity futures. So the futures are linked to agricultural commodities like wheat and cotton, etc. Precious metals, minerals, etc. So there is gold, silver, petroleum, etc. So actually commodity futures means it's an agreement to buy or sell wheat in the future at a particular price. That's all. Or it's an agreement to buy or sell cotton in the future at a price fixed per kilogram. What is the price? The price is fixed now. But the price for the transaction, future transaction is fixed. And you can also fix the time, 3 months or 2 months or 6 months. You can fix the time and the price. So the commodity futures means agreements to buy or sell commodities in the future at fixed prices. Next, currency futures. So here the future is linked to a currency. Foreign currencies like dollar, euro, etc. So again, it is an agreement to buy or sell dollar, or it is an agreement to buy or sell euro in the future at a fixed price. Index futures. The stock market, each stock market has their own index. NSE has Nifty. Nifty is the index of NSE. Bombay Stock Exchange, Sensex is the index of Bombay Stock Exchange. USA, there is S&P is the index of US stock market. London stock market, FTSE, FTSE 100 is the index of the London stock market. So stock indices. So index futures means the futures are linked to indexes, the indices there. So it's an agreement to buy or sell an stock market index. See, now stock futures. Stock futures, that means the futures are linked to stocks or shares. So it's an agreement to buy or sell shares in the future at a fixed price. So stock futures means it's an agreement to buy or sell shares in the future at a fixed price. Okay. Interest rate futures, okay, that's not very common. Okay, that will leave it. So look here, commodity futures, currency futures, index futures, stock futures. We are interested in stock futures because we are dealing with investment. We are not dealing with currency and commodity. We are your subject is investment, risk management in investment. So we are interested in stock futures. We will see how stock futures can be used for risk management in investment in shares. Okay. Uses of futures. What is the use of future? We know the use. I have been speaking about it. The use of future is for hedging existing risk. So the use of the future or any derivative is hedging existing risk. Risk is the possibility of incurring a loss because of the fluctuations in prices of shares or currencies or commodities. Okay. However, this is the real use of the future, but it can be misused for speculation. The use is hedging. Derivatives have been created for hedging the risk, but people are very clever, so we try to misuse it for speculation. So we can say that there are two uses. One is a regular use, the other is a misuse, that is for making speculative profit. So it can be used for two different purposes, two opposite purposes. One is to eliminate the risk, the other is to make a speculative profit. Let us take two examples for each of them. Stock futures as a hedging tool. That is what we are studying, how to use derivatives for risk management, investment. Stock futures, that is an agreement to buy or sell stock or shares in the future. That's called stock futures. How is it used as a hedging tool? Now, let us say an investor is expecting to receive some money for investment in a share. You are expecting your, say, salary arrears. So teachers, you every 10 years you get UGC arrears. UGC pay is revised, but you don't get the arrears immediately. The arrears comes after 2-3 years as a lump sum. Supposing you want to invest that money in a share because the money is surplus money, so you can afford to invest in a share. So an investor is expecting to receive some money for investment in a share, or he is selling some land and he wants to invest there. Somebody said investing in shares is very good, so he is expecting to invest in a share, but he does not have the money now. He is going to receive the money in the future after some time. So he is planning to invest in the market, share market. But meanwhile, a rise in the share price is anticipated. So he is studying the market, and now he has understood that there are so many reports saying that there is going to be a rise in the share prices. So by the time the money comes to his hands, the market share prices might have already increased, and therefore he will have to buy at a higher price. So there is a risk involved there, possibility of having to pay higher price, so possibility of incurring a loss. What to do? So this is the situation. See here, what to do? That is the situation. It's very clear. Let the share price go up, no problem. In the future, share price is going to increase in the future. So what he can do is he can enter into an agreement today. He can enter into an agreement to buy shares in the future at a fixed price. So he can fix the price today. So he can buy stock futures at around the current price of the share. Buy stock futures means enter into an agreement. Buy stock futures means enter into an agreement to buy the shares in the future at a fixed price. So he is fixing the price today. So even if the share price increases in the future, when he receives the money, he can buy the shares at the price fixed today by his agreement. And that agreement is called a stock future. So he's eliminating his risk there. In future, even if the price of the share has risen, he can buy the share at the predetermined price. That is the price as per the agreement. So in future, even if the price of the share has increased, it does not affect him because he has entered into an agreement to buy the share, that particular share at a fixed price, and he will buy at that fixed price. So his risk is eliminated. So this is how stock futures can be used as a hedging tool. Now let us see how speculation using futures. Let's take an example of how somebody is using stock futures for speculation. Okay. A share is currently priced at rupees 320. Right? A share is currently priced at 320. An increase in the share is anticipated. So this share is good share, and we are expecting that the share price will go up to around 400 rupees or more than 450 rupees. So in the future, next 6 months or so, we are anticipating that the share price is going to increase. Okay. Now, one thing that you can do is you can buy the share by paying 320 because you are anticipating the share price will go up. So it's a good investment. You can make an investment here, buy the share at 320. Later on, sell it at 450. Now, there is an easier way. In fact, you don't have to buy the share at 320. There's an opportunity here to make a speculative profit. There's an opportunity to make profit. This opportunity can be exploited in two ways. One is to buy the share. A person who has not studied derivatives will naturally buy the share and sell it later at a higher price. Okay. So there's an opportunity. One is to buy the share. A person who doesn't know anything about derivatives will do that. But if you have studied about derivatives, there's no need to buy the share by paying the full market price. We need not buy the share by paying the full market price. What you have to do is you can enter into a futures contract to buy the share in the future at the current market price by paying a small part of the price money, or called margin money or advance money. See, in the case of a luxury car, you have to pay an advance. In the case of real estate, when you are buying land, when you make the agreement, you have to pay a small amount as advance. So similarly here also in the futures contract, you have to make a you are agreeing to buy in the future. So therefore, you have to make an advance payment. A small amount has to be paid. So here, what he can do is he need not buy the share. He will enter into a future. He will use a derivative here. He will enter into a futures contract. That's a derivative. He will enter in an agreement, a futures contract, to buy the share in the future at the current price. The price is fixed to 320. Okay. So he enters into an agreement to buy the share in the future at 320, and he pays only maybe say 10%, 32 rupees or 30 rupees. He pays a 10% margin, 30 rupees will be paid as advance, and he will sign an agreement. That's all. Instead of paying 320 rupees and buying the share, he will simply pay 30 rupees and sign an agreement which says that he is prepared to buy the share in the future at 320 rupees. When the price goes up, this contract will be executed. That is, he has agreed to buy at 320. He will now buy at 320, immediately sell it at 450 rupees. So in the future, when the price has gone up, he will buy the share and sell it. So actually, he need not buy and sell. The difference in the price will be paid to him. That's all. So that is called, the contract can be closed by selling the share at the enhanced price. So he had agreed to buy at 320. Now the price is 450. So the original contract will be closed by another contract saying that he is selling the share at 450. The difference in the price is the profit, and that will be paid to him. His investment is only 30 rupees. So that is speculation. Just by paying 30 rupees, he is making a profit of, let us say, if it is 450 rupees, that means 120 rupees profit he is making. See, so that is only the person, if he knows what is derivative, he can use it for hedging the risk as well as for making speculative profit. So that is why derivatives are becoming popular. That is why derivatives are becoming very popular nowadays, because people who know derivatives will use it for both purposes, for hedging the risk as well as for making speculative profit. So it is a way of investment also. You see that it is not only for hedging the risk, it is investment itself. You can use derivatives for making profit, for investment, but that investment is a speculation. It's a speculation, because if the price does not rise, then he will lose the money. He will lose the 30 rupees. That is why it is called a speculation. Okay. Futures exchanges. Where do we get these futures? Just the futures part, I will conclude by saying that where do you get these? Where do you enter into this agreement? For commodity futures, if you want to enter into an agreement to buy and sell commodities, there are commodity exchanges which are separate. Commodity exchanges, that is National Multi-Commodity Futures Exchanges, NMCE, MCX, NCDX. They have trading all over India. They're all online trading. From anywhere in India, you can do the trading there. You can buy any commodity there. So that's why national multi-commodity futures exchanges. Then for specific commodities, there are specific commodity futures exchanges like International Pepper Futures Exchange in Cochin, where you can buy and sell only pepper. Coffee Futures Exchange in Bangalore, where you can buy and sell only coffee. But this coffee and pepper can be purchased in the National Multi-Commodity Exchanges also. So people will prefer the National Multi-Commodity Exchanges. Okay. Then financial futures, that is stock futures, index futures, and so on. See, in NSE and BSE, there are separate F&O section. F&O means futures and options. Futures and options, F&O. Futures and options. Those are two derivative instruments, popular derivative instruments. So there's a separate section for trading of derivatives. It is called F&O in NSE and BSE. Currency futures exchanges, again, there are separate currency derivatives section in NSE and BSE. So in NSE and BSE, there is a separate section for F&O and also separate section for currency derivatives. There is a separate currency derivatives exchange called USC, United Stock Exchange, USC, that is only dealing with the currency derivatives. So these are the futures exchanges. We are coming to the third instrument, options. I think I'll just give you just 5 minutes break. Somebody wants to have tea or just to have relax. Just 5 minutes, okay. It's now 11:12. We'll come back by 11:17. Okay. Is it okay?
Okay, sir. Okay, sir.
5 minutes.
Sir, excuse me. For the organizer.
Hello. Hello, ma'am.
Good. Ma'am,
I can't hear you properly.
actually, the attendance, how we have to give attendance for the session, will be taken as such, or we are supposed to?
We have a provision to download the attendance in Teams. Otherwise, apart from that, we will be circulating a feedback form at the end of each session.
Okay.
Okay, welcome back. I think we can start.
Yes, sir.
Okay. So we are going to see the last part, the third instrument, derivative instruments. We have seen that derivatives are hedging instruments. There are three types of instruments. Any of them can be used for hedging the risk in investment or currency transaction or commodity transaction. The third is called option, and that is in fact the best instrument. So the three are equally useful, but options is considered to be the best instrument derivative. So that's why I said I want to spend some time on options also. Let us try to understand what is an option. So let's look at the word option. Option is an English word which means you have a choice to do something. You have the option to go to this particular shop or that particular shop, or you have the option to buy this book. So option means it is left to us. It is our choice. If you want to do it, you do it or don't do it. So option is a choice. It's an English word. Dictionary. If you refer to the dictionary, you will get the meaning choice to do or not to do something. Okay, so now more or less the same meaning comes here in the case of derivatives also. It's also an agreement. We will see that now. But the best way to understand option is to take again. Option is it is there in practical life. We see it every day, so it's nothing new there. Only we lately we called it a derivative. So this option is also in practical life. We are every day seeing it. So I'll take an example from our day-to-day life so that that gives you a better idea about what is an option contract. Okay, so let us take an example from everyday life. Very familiar, very common, so that we can very clearly understand what is meant by an option. So, railway platform ticket. All of you are familiar with the railways. All of you, I'm sure, would have traveled by the railways. But when for traveling, you purchase the ticket for traveling. But there is something called a railway platform ticket. I know all of you are familiar with that. So what we do here is you purchase the railway platform ticket. I think it is now 10 rupees. Earlier it was 5 rupees, I think. Now I think it is 10 rupees. So it's a small amount. For a small amount, you will get a ticket. And when you buy this ticket, actually, what you get? First of all, it is an agreement. Who is the buyer? You are the buyer. Who is the seller? The railway is the seller. So it's actually this ticket is an agreement between the buyer and the seller, the railway and you. Okay, you are paying 10 rupees. You get a ticket, and this ticket gives you a right to enter the platform and remain in the platform for, I think, 3 hours. Okay, so this ticket, you paid for it, you got a ticket. This ticket gives you, the railway is giving you a right. Through this ticket, the railway is giving you a right. So you are the buyer is getting a right to do something. A right to do something. What is that? To enter the platform, remain in the platform for 3 hours. It is a right. That means it's a choice. It is not compulsory that you should enter the platform. It's not compulsory. Nobody is going to push you into the platform. It's not compulsory. It's not mandatory. It is a right if you want to enter the platform. Otherwise, don't enter the platform. Nobody is going to bother about it. It is up to you. It is your right. You have an option. So you have an option to enter the platform or not to enter the platform. If you don't want to enter the platform, okay. But this right will expire. This right will expire in 3 hours. So after 3 hours, if you do not enter the platform, the right is gone. It's lost. So you have to exercise the right. Show it to the guard there, show it to the guard and exercise your right and enter the platform. If you don't enter it, okay, fine. After 3 hours, the right is over. Your right will be lost. So you have a right. Now, the seller has no right. The seller has an obligation. If you go to the guard and ask to enter, he has to allow you because you have the ticket there. So he cannot prevent you. He has no right. He has an obligation. So the buyer has the right, the seller has the obligation to allow you to enter the platform and remain in the platform. Okay, so a right option, railway platform ticket is an example of an option. It gives the buyer a right to do something or not to do it. It's not compulsory, but the seller of the option has the obligation to allow the buyer to do whatever he wants to do as per this agreement. So, and there's a time period also within which the right will expire if it is not used. So this is the definition of an option. So let's look at the definition of an option. It's an agreement again, a contract giving a right. Giving a right to buy or sell. So if you want, you can buy. If you want, you can sell. It's not compulsory that you should buy or sell. It is giving you a right to buy or sell a specific asset, a share or a currency or a commodity at a specific price. So you are getting a right to buy this share or sell this share at a particular price, a specific price. So the price is fixed. The price for exercising the right of buying and selling is fixed. Time is also fixed within a specific time period. So it is just like the forwards and futures. Forwards and futures, you are agreeing to buy or sell. Here you are, there's an agreement which gives you a right to buy or sell. If you want, you can buy. If you don't want, you don't buy. But the price is fixed, the time is fixed. That is the difference. So here it is more flexible. The buyer has a right to buy or sell. If it is advantageous to him, he will buy. If it is not advantageous to him, he will not buy. When we take an example, you will understand it better. So this is the definition. So there are two types of rights. One is the right to buy, call option. It's called call option. It's the right to buy a share, which is useful in a rising market when the prices are going up. The other is the put option. Put means sell. A right to sell a share. So options, there are two types of options. One is a right to buy, the other is a right to sell. Call option is the right to buy and the put option is the right to sell. Now, to get this right, you have to pay a small price, just like the platform ticket price. A small price has to be paid. Options, two terms are important here. One is premium, that is the price paid for buying an option is called option premium. It will be a small amount usually. And the exercise price, another term used is the exercise price. Sometimes it is called the strike price. The price at which you can exercise your right. That is, the call option means the price at which you can buy the asset. If it is a put option, then it is the price at which the asset can be sold by you. So that price at which you can buy or sell is called the exercise price or strike price. Okay, now we will take an example. The characteristics, just to put it in perspective, there is an underlying asset. So you are getting a right to buy or sell a particular share. Let us take as an example TCS, Tata Consultancy Services. So the share of, you are going to get the right to buy the share of TCS. The exercise price is 870. So you are getting the right to buy the share at 870. The expiry month, the time is May. Supposing it is any you can fix any month. That is, before that you have to exercise your right. And the type of option is call option. That is, you have a right to buy the share at 870 rupees before May. And for this right, you have to pay a small price, option price called premium. Let us say it is 10 rupees. Okay. The quotation will be given like this in the newspapers. TCS 870 May call at rupees 10. So everything is there. All the characteristics of the option is there. I think we'll take an example now. Parties to the options contract is the purchaser, is the investor. He has the right. He has the right. So he may exercise, he may not exercise. He may buy. If it is a call option, he may buy or he may not buy. If it is a put option, he may sell or he may not sell. So he has the right. The seller usually is a speculator, is called the writer or sometimes. He has the obligation to perform. If the purchaser exercises the right to buy, this person has to sell it by So buying and selling, call option, if the purchaser wants to buy, then the seller has to sell it to him. So it is obligation, compulsory. For the speculator or the seller, it is compulsory if the purchaser exercises his right. If the purchaser does not exercise his right, no problem. So the purchaser will buy the right from the seller by paying 10 rupees. The previous case, the purchaser will pay 10 rupees to the seller and he will get the right to buy the TCS share at 870 rupees before May. If he does not exercise, the 10 rupees is the seller's profit. That's all. So the seller will get a profit of 10 rupees if he does not exercise his right. If he exercises his right to buy it at 870, the seller will have to buy the share from somewhere and give it to him at 870 rupees. So that is the two parties to the options contract. Let us understand this example. There is a call option with exercise price of 120 and premium of rupees 7. So you paid 7 rupees, you purchased a call option to buy a share, and the exercise price is 120. That means you have a right to buy this share at 120. Okay. Now, what will you do? So you're keeping the right. What is the use? What is the use of this right? See, the share prices in the market will go up and down. Sometimes it may go up, sometimes it may come down. Let us assume that the share price goes up to 140. If the market price rises to 140, now this person has a right to buy the share at 120. Now the market price is 140. He has a right to buy at 120. That means it is advantageous to him to exercise the right. So if he wants, he can buy. It is a right. It is not compulsory. If he wants, he can buy now, or he can wait. He can wait for the share price to go up to 150 or 160. But if he thinks that, okay, he wants to exercise the right, he will exercise. So see, when the market price rises to 140, the purchaser will exercise and gain net profit of 13. You know how the net profit of 13 comes? He will buy at 120. He will sell it immediately at 140 because the price in the market is 140. So the gross profit is 20 rupees, but he has already paid 7 rupees to get this right. So his net profit is only 20 minus 7, 13. So the purchaser, by exercising his right, will get 13 rupees profit, and naturally the seller, the writer, seller will lose 13 rupees because he will have to buy from the market at 140 rupees and give to him at 120 rupees. So the seller will have to buy the share from the market at 140 rupees and sell it to him at 120 rupees because that is his obligation. And therefore he suffers a loss of 20 rupees, but he has got 7 rupees from the purchaser as the premium. So his net loss is only 13. Now, if the market price falls to 90, so there is 3 months time is there. Within that 3 months time, he has to exercise his right. The market price is remaining at 90. The market price is remaining at 90 rupees. So he has the right to buy at 120 rupees. The market price is 90. Will he exercise his right to buy at 120? That is foolish because the share is available in the market at 90 rupees. So if he wants the share, he will not exercise the right. He will let the right go. The right will lapse because there's no point in buying at 120. It is available at 90 rupees. So he will not exercise the right now. He will not exercise the right. So what will he lose? He will lose 7 rupees because he already paid 7 rupees to get the right. So that is a loss to him. But he can buy the share from the market at 90 rupees because the share price is only 90. So he can buy at 90 rupees. He need not exercise the right. So either way, a person who has purchased the option, whether the price is going up or the price is coming down, he is gaining. That is the advantage of options trading. Option is a very good instrument So in both the rising market and the falling market, if you have an option, you will make profit. So that is the advantage of options. So derivatives, knowing derivatives, a person who is interested in the share market, who wants to make some investment in the share market, should definitely understand derivatives also, because they are complementary. Investing in the share market and using derivatives are complementary. You should definitely know what is meant by derivatives, how are they used. So those three instruments, forward, forwards you can leave out because forwards are dealing only with currency. Futures and options you have to understand and use it in the market when you are investing. So that is the purpose of this lecture, to make you familiar with the derivatives. Okay, so let us the options market. There are two you can buy and sell the options in NSE and BSE. F&O, futures and options segment of NSE and BSE, that is in the exchange you can buy and sell, or it is also can be purchased in the OTC market. Also it is available between banks, interbank, bank to customer dealings. So both markets are available. Exchange is available, OTC market is available for options. So option is a very good instrument. Let us look at options now. What is the use of options trading? So in your investment, how can you use options? So we call it option strategies. There are, one is to protect a profit on a share. You can use it to protect a profit on a share. I'll show you with an example. You can hedge an existing risk because it is a derivative. You can also misuse it for speculative profit through leverage. So you can use it for hedging. You can misuse it for speculative profit. Then protect the profit on a share. So we'll take 3 examples to show you each of this, and with that I will wind up. Okay, it's already 11:35. Okay, right. So with these 3 examples, I can finish my presentation and then I can take questions from you. Okay, protect the profit on share. Supposing you purchased a share at 32 rupees. You are hoping that the share price will go. These are all typical situations faced by ordinary people, and they don't know what to do. So people who do not know derivatives will be confused. They don't know what to do. So you purchased a share at rupees 32, hoping that the share price will go up, and in some cases it will go up, in some cases it will come down. We don't know what will happen. Let us assume that the current market price is 56. So as expected, the share price has gone up. Okay, there is a profit of 24 rupees already. You have not sold it, but you purchased at 32, now it is 56. Now you have to take a decision. The investor is confused. What should he do? Should he sell now at 56? He can sell, no problem. If he sells, he will get 24 rupees. But then sometimes after he sells it, the share price may go up to 100. Then he will feel desperate, very sad. He will regret that he sold it at 56. So he does not know actually. This is an actual situation. So the investor will not know what to do. Should he sell it or not sell it? Should he wait for the price to increase? So if he sells it, he will get 24 rupees. But then if the price goes up, he will feel very bad. Okay, supposing he does not sell, hoping that the share price will go up to 100. Unfortunately, next day, the price becomes 50. Next week, the price becomes 40. Next week, the price becomes 20. Again, he will feel sad. Are you getting my point? So you don't know what to do, because we don't know what will happen to the share market. Will the share price go up or go down? You already have a profit of 24. So how do you see the title of the slide? How to protect the profit on the share. This share now has a profit of 24. We want to protect this and also get more profit if the share price goes up. If you sell it off right away, you will get the 24 rupees profit, but future profits you will not get. So you want to protect this profit, retain the share, and get more profit in the future. All these things you want to do. What to do? Very simple. See here. To protect the gain, the investor will buy a put option. The investor will buy a put option. Put option means the right to sell. So the investor will buy a put option, a right to sell this share at rupees 55 for a premium of 3 rupees. So he will pay just 3 rupees. He will get a right. And what is the right? The right to sell the share at rupees 55. Okay. Now he's waiting. He's not doing anything. He paid just 3 rupees, got a right to sell the share at rupees 55. He's now waiting. Two things may happen. The price may go down. The price may go down to 25. Then he will exercise his right to sell it at 55, even though the price is 20 or 25. He has a right to sell it at 55. So if the price is going down, the share is falling, then he will exercise his right to sell the share at 55, so that he has got a profit now, even though market has gone down. On the contrary, the other option is sometimes the share price will go up. It may become 60, 70, 80, 85. So the price is 85 now. 85. So he will not exercise this right to sell at 55. He will not exercise that right to sell at 55. Instead, he will sell the share directly in the market at 85. The current price is 85. So he will sell at 85. He will get more profit. This right he will not exercise. So 3 rupees he will lose. That's all. So you see, so even if the market goes down, he will make profit. Or if the market goes up, he will make more profit. So he's in a very safe position. He has protected his profit on the share. The price falls, investor can exercise the right and get a profit of 20. That is 55 minus 32 minus 3, 20. If the price rises, the right will not be exercised. Investor just loses 3 rupees but gains higher capital gains. So you see how option has helped him to make a profit in a very confusing, difficult situation. So it's a helping instrument. Derivatives are helping instruments. Now, hedging an existing risk. Hedging an existing risk. Let us take a mutual fund as announced a scheme. In the beginning, I said mutual fund has announced a scheme. Money will be collected only 1 month later, say May or January or whatever is the time. And they have found out one good share which they want to buy. The mutual fund has analyzed and found that a particular share is very good. The current market price of the share is 127, but an increase is anticipated. So by the time they get the money, the price of the share will become 150 rupees. So they will have to buy at 150 rupees. It's a good share. So that is a loss. So it will be ideal if we can buy the share at 127. So what he will do is two things are possible. Either he can enter into a futures contract, which we studied earlier. He can enter into a futures contract to buy the share in the future at say 130 rupees. So fix the price at 130, enter into an agreement, futures agreement to buy the share at 130 in the future. Or he will buy a call option. See, the mutual fund buys a call option, which is expiring in May. The price 130. The exercise price is 130. That is, call option means he gets a right to buy. So he gets a right to buy at 130 at rupees 6. At rupees 6. So he pays 6 rupees. He gets a right to buy at 130 rupees. So if the price goes up higher and higher, he will exercise his right and buy the share at 130. But if the share price goes down to 100, supposing the share price goes down to 100, then he will not exercise this right. Instead, he will buy from the market at the lower price of 100 rupees. See, so call option is used here to hedge an existing risk. Now, the difference between futures and options. Futures is an agreement to buy. So if he enters into a futures contract to buy at 130, he has to buy. So even if the market has gone down to 100, he has to buy as per the agreement, because that is an agreement to buy. So he has to buy at 130. He cannot make use of that decline in the share prices. Whereas this is a right to buy. So option is better. So this is a right to buy. So if the share price has gone down to 100, then he need not buy, exercise this right. It's not compulsory. So he can leave it, just leave it and go to the market and buy it 100 rupees. But in a futures contract, that is not possible. So option is always better than futures. Okay. So that is what I said. If the price is rising, he can exercise his right and buy at 130. If the price is falling, the mutual fund can buy from the market at the lower price. Okay, now speculation. Make a speculative profit. What is the third use of the option is to make a speculative profit. The current market price of the share is 63. There is a share in the market, 63, good share. You want to buy it. An increase is anticipated, therefore, it is a good share, you can buy it. So you expect that it will go up to 100 rupees or 120 rupees. So you want to buy it. There's an opportunity for making a profit. What to do? An investor who does not know anything about derivatives will buy the share at 63 rupees. He will buy the share, naturally. An investor will buy the share. He does not know anything about derivatives, options, futures, etc. He will sell it later at 86. When the price becomes 86, he will sell it and he will make a profit at 23. That is 63, 86 minus 23. And his investment is 63 rupees. Rate of return is 23 divided by 63 into 100, 36.5%. That is what an investor does. But it is not necessary. You need not buy the share. Instead, you can buy a call option. See, another investor who has studied about derivatives, he will buy a call option at the exercise price of 65. Call option means the right to buy. So he will buy a right to buy this share at 65 rupees for a premium of 5 rupees. So he just pays 5 rupees. He gets the right. What is the right? The right is to buy this share at rupees 65. Later on, when the exercise price, when the price of the share becomes 86, when the share price becomes 80, he will exercise his option when the price is 86. So he has a right to buy at 65. So he will buy at 65, sell it at 86. So his profit is 86 minus 65 minus 5 because he paid a premium of 5 rupees. So his profit is 16 rupees. 16 rupees. But his investment is only 5 rupees. See, his investment is only 5 rupees. I'll just hide this. Okay, 1 second. Okay. His investment is only 5 rupees. So his profit percentage is 16 by 5 into 100. Just by paying 5 rupees premium, here he is making a profit of 16 rupees. So 16 by 5 into 100 is 320. Whereas if he purchase the share, his rate of return percentage would be only 36.5. In this case, with just 5 rupees, he makes a profit of 16 rupees. The rate of return is 320. Definitely, it is speculation, speculative profit. With small investment, you make large profit. Derivatives can be used. Options can be used. Okay, so it is more attractive to trade a derivative security than the security itself. See, from this example, what we are understanding is that it is more attractive to trade a derivative security options than the security itself. When an increase in the share price is anticipated, investor will buy the share, but an investor who knows about derivatives can buy a call option in the share. The latter choice is better. With small investment, large profits can be made. Concluding remarks to the whole session, derivatives trading has become a significant activity in the Indian economy. Not only Indian economy, the global economy. It has applications in diverse domains, even though we were dealing with investment only. It has applications in diverse domains such as commodity, equity, currency, and it is useful in hedging the risk in the market. It's a hedging instrument. Derivatives are hedging instruments. It is often misused for speculative gains also. It is often misused for speculative gains. Okay, I have a book on those who want to understand more about derivatives. You can refer to this book written by me, Commodity and Financial Derivatives. It's used as a text for MCOM, MBA, and so on. Then if you want to know about investment, there's another book called Security Analysis and Portfolio Management. All these are published by Prentice Hall of India. The second book is about investment in share market. Again, a third book, portfolio management. So first book is on derivatives, second and third are on investments. I have another book on international finance. There's another book on research methodology also. Okay, I think. Thank you all. I should stop here and let me come back. Yes. Yes, so I hope I have not taken too much time. Yes, it's almost 11:50. Right. So we can have question answer sessions. Yes.
Participants, you can ask questions.
Okay. Yes. Go ahead.
Sir,
Yes.
how can we determine the price of a future or futures contract?
That is there are formulas for that. Pricing of futures, pricing of options, all these cannot be explained in one or two sentences. It's based on certain models, mathematical models. So that if I'm taking a session on derivatives, I could have explained that. In my book, all those are explained, So futures, it's a good question, but it is a mathematical question dealing with mathematical formulas and models. So that has to be referred to the text. Okay, you are teaching the subject? Are you teaching the
Yes, sir.
subject? Okay.
Yes, sir.
Mhm.
Faculty, I have completed my thesis in commodity derivatives and risk management.
Right. So it's a risk management tool. So you refer to my book. There are several examples are given.
Yes, sir.
Mhm.
Yes, I have referred. And
Yeah.
one more question.
Yeah.
Why the futures contract are converging at the end of the trading day?
Because that is because what happens is see the futures price and the spot price. The futures price is based on the time of expiry. The larger the time of expiry, the futures price will be higher. So supposing the futures has 1 month to expire, then there's 1 month's opportunity for people to make exercise the right. So the price will be more. But then supposing tomorrow it is expiring, so there's only 1 day opportunity to exercise. So the price difference will be very less. So on the last day, both the price will be the same. Understood. Because that difference in the price is the opportunity to make profit.
Okay, sir. Majority of the contracts are converging at the end of the trading day. Here, spot price is to futures price.
Right. That's good.
Okay, thank you.
Okay, you know the subject. That's why you're asking that question. Okay. Right. Okay. I hope the presentation was clear, though even those who have not.
Good morning, sir.
Yeah.
May I?
Yes.
My name is Susan, sir. My question is from a layman's point of view.
Right.
So to buy a share, you need to get a demat account. You go to a share broking firm and all those things.
Yes.
But if I want to participate in the derivatives market, how do I go about it practically?
Same derivative demat account is enough.
Oh,
if you have
okay.
a demat account, the same account is enough. With that demat account, you can use both trading in shares and derivatives trading. Both can be done.
Okay, so sir, when suppose I'm starting with it for the first time, I really don't have much of an idea except all these lectures I've heard or talks I've heard about it. So,
Right.
Is there some way I can get some help? For example, will a share broking firm or a broker be? Do they provide us with tips and advices and how to go about it?
Understand. I'll tell you. See, what happens is they usually, the brokers, share broking firms, they will have advisors. So if you say that I want an advisor, they will allot an advisor to you, and that advisor will be able to help you with the, he will give you different choices, but finally the choice is ours. So he will give you different choices. So we have to think about it, study it, and then give him, okay, you do this. So 3 or 4 alternatives, you'll say this share is good, that share is good. Final choice is ours. That is the way it should be. So they will help with, advisors will be there. And in the initial stages, you can seek the advisors' help. But always go for long-term investment. Don't go for short-term investment. Don't hope to make a profit in 3 months' time or 4 months' time. It takes years, 2 years, 3 years. So go for long-term investment in good securities. That is the one simple advice which I can give you. Okay.
Okay, sir. Thank you.
Don't try to get short-term gain. It's not possible.
Okay, sir. Thank you.
Okay. Right. Any more questions? I think because it was a preliminary basic session, not many questions are there, I hope.
Yes, sir. Yes. Any questions? Anup?
Can we wind up?
Yeah.
Okay. As we all know, Well Begun is half done, and Kevin sir did the same for us. He keep all the things as much as simple, like what he did in his books. And really, I don't have words to express my feelings, because from you we learned security analysis and financial management, and you are being a part in our faculty development program. It's a prestigious moment for Sri Shankara College Kaladi and PG Department of Commerce. We are grateful to you, sir. Thanks for your time, and thanks for your energy, sir, and thanks, of course, for your words. Thank you, sir. Thank you so much.
I'm happy to be part of your faculty development program, because wherever I can share some knowledge, I'm willing to do that. Okay.
Okay, thank you so much, sir.
So all the best for the rest of the, today is the beginning, isn't it? So
yes, yes.
Yeah.
So
all the best for the rest of the sessions also. It will be very useful to the participants. So thank you, participants, also for patiently listening to me. Okay. All the best.
Thank you, sir. Thank you so much for joining us.
Okay.
Thank you so much, sir. Thank you so much, sir. For a layman, it was very, very, very informative. Thank you so much.
Good.
Thank you, sir.
Okay. With your permission, I leave.
Session
Okay.
will be at
Thank you, sir. Thank you.
join.
Dear participants, the next session will be at 2 p.m. By Dr. T. Mallikarjunappa, sir. Please join us on time, and please note that we have a attendance list from teams. At the same time, we will be circulating the feedback form. Both will be sent to Stride after each session. So please stick on to the time, and your participation is appreciated from our end. Thank you so much.
Thank you all.